In this video, we will talk about Fubotv, the recent news and updates, and if you should buy its shares. Before today's video begins, if you like my content, please like, comment, and subscribe to my channel. Fubotv is a streaming platform focusing on sport events and entertainment. Its stock has been in a bullish trend since October 2020, increasing from $10 to a peak of $62 in late December. Since then, there has been a major price correction to the level of $27. This price correction is mostly caused by investors locking in their profit after such a spectacular surge, with a smaller reason in that some analysts have doubts about Fubo's strategies and current financial performance, which we will talk about in this video as well. Since then, the stock has regained some of its value around $38. The reason behind this recent price increase is the acquisition of Victory, specialized in online betting. Fubotv expects to develop a sports hook by the end of 2021 and generate revenue in synergy with its sports streaming channels, especially ESPN. This prospect has given a lot of hype to investors because of the current wave of legalization regarding online gambling in many states, and the fact that Fubo has sports channels to increase the exposure of its sportsbook branch for higher growth. On paper at least, this strategy works well. There is a large portion of Fubo's subscriber base that is already interested in sports events, and at least a significant portion of them have been exposed to sports betting in the past. What Fubo does is to create an environment where a subscriber is more likely to participate in those events, therefore generate more income and profit for the company. This is the immediate term, so we have this news acquisition coming in and the stock price has gone up. Over the long term, however, I believe that there are serious hurdles that this company needs to overcome in order to develop a sustainable business model. It is true that a company is growing. Its quarterly revenue almost increases by 40% compared to previous quarter. The issue is in its expense. Its expenses are almost double its revenue level, and many of those seem to be operative expense. The reason why this may be a serious problem for Fubo is that if those expenses are operative instead of R&D or client acquisition, then this means that they cannot be decreased over time. One example is the subscriber-related expense found in their quarterly filing. The subscriptions revenue in both those quarters have shown significant progress, but in both cases, the subscriber expenses have been higher than the revenue they were supposed to generate. This expense, in my understanding, is basically the affiliate payments they sent to advertisers, smart TV boxes companies that broadcast Fubotv. Now, we can understand this expense as client acquisition, but in my opinion, it is closer to an ongoing affiliate payment that they need to pay to their broadcasters or promoters. If that is the case, then there are reasons to believe that it may not come down in the foreseeable future. There is no additional disclosure from the company regarding what this expense means, but if the subscriber expense is paid to the different smart TV networks, those expenses may not come down since they need those networks more than those networks need them. The reason why I put so much emphasis on this one particular expense is because I believe that this is a variable cost that changes with the size of its subscribers, unlike the other costs such as sales, marketing, or general admin expenses, which are fixed costs. Another way to see it is that the streaming service itself does not currently provide a positive cash flow, much less a profit. Fubo is putting a lot of hope in the sports betting segment to increase its revenue and profitability. The future will tell us if it is enough. Personally, I see Fubotv as a platform that targets people who still watch the content from cable TVs but who no longer want to be attached by a contract. In other words, the people who either have cut their cable cords or who are considering cutting it. For people who have not been watching those channels for multiple years, or the so-called cord never, Fubotv along with YouTube TV may not be an attractive option. Keep that in mind as we analyze the service. In terms of price action, the market has reacted positively to the acquisition, and there is a decent probability that the stock will rise higher over the next few weeks as the company further discloses information regarding the price of the acquisition, the detailed plan to develop a gamebook segment, and how they plan to monetize this. For those considering to buy the shares, I would recommend prioritizing trading over holding. Currently, there is a lot of hype in the market, a lot of hope for the company to become profitable. However, I believe that this is not just because Fubo purchased Victory, but because traders, speculators, and investors all alike needed to park their money somewhere without losing a significant portion of their investment. There are not that many places satisfying their need in 2020 and arguably a significant portion of 2021. What they have are the SPACs, tech companies, EV startups, and internet-based services. Apart from a few companies that are now delivering solid results, many of those companies that I just mentioned are still selling a dream based on a PowerPoint presentation. The dream that they will all grow exponentially larger than where they are now, and that it will happen in the next few years. Fubo does have a relatively tangible business presence, but even so, this company is currently losing money, and they are also selling a projection of the future. This is very good news for the stock in the short to medium term, since the demand is stimulated by those announcements. In the long term, however, the investors will have to look at the actual results. This is where a lot of the companies may face very difficult decisions because tractions, exposure, and growth cannot replace revenue, costs, and profit. Another aspect to keep in mind is that Fubo needs to keep investing in the platform in order for revenue and market share to grow. In other words, it needs to throw cash at its operating losses for at least the next 12 months. This means there could be more stock dilutions coming down the pipe, especially since the company cannot overly rely on debt financing due to requirements on liquidity and solvency ratios. When we look at the options for Fubo, there is a lot of demand for both the call and put options. Call options allow holders to buy the stock at strike price, and put options allow holders to sell stock at a strike price. There are more call options bought than put options, meaning that the market consensus is that stock price will go higher. The main region where the call options are bought is between $30 and $40, meaning the current price level of $35 may be a good entry point. Based on those observations, I believe that if your goal is to trade the stock, then the current price level may be a good entry point. If your goal is to buy and hold the stock for the long term, I would suggest building your position over multiple months to make sure that your cost is as low as possible with a reduced allocation to it. Given that a company is still in its growth phase, my recommendation for maximum exposure is 2% of your portfolio if you're trading and 1% if you're holding for the long term. The target price should be between $50 and $60 over the next 6 months. Thank you very much for watching. If you like my content, please like, comment, and subscribe to my channel.